Hey guys, I'm Greg Hardy and welcome to my channel. The value of used cars has dropped significantly from their pandemic era peaks, which is leading many Americans to owe more on their auto loans than what their vehicles are currently worth. This means you'll end up financing both the remaining balance of your old car and the cost of the new car, leading to higher monthly payments and increased overall debt. This can be financially risky as it may be leaving you paying much more in interest and struggling with a higher loan balance that can take longer to pay off. According to Experian, the average monthly car loan payment in the U.S. for new vehicles was $735 and $523 for used vehicles in the first quarter of 2024. However, other industry analysts have reported even higher figures. The June 2024 Cox Automotive Moody's Analytics New Vehicle Affordability Index showed the average monthly car payment at $752 for May 2024. The average new car buyer paid $48,644 in June, and the average used car was listed for $25,251. While the price of new and used cars may be falling, the cost to keep them isn't. So in this video, we're going to examine the true cost to own a car and some ways that you can lower that cost. But before we get into all of that, I ask that you hit that like button and also consider subscribing to this channel if you're wanting to grow your wealth. It will also allow this video to reach a wider audience and help even more people. Now let's get started. As of July 2024, the average car loan interest rate is 9.56%. Auto loan annual percentage rates, or APRs, are the most common rates you'll see advertised on auto loan sites. APRs include your interest rate along with other fees and costs that come with the auto loan. Lenders set interest rates partly based on how likely you are to repay that loan. If the loan seems risky to them, they will charge a higher interest rate. Several things can show risk to lenders and affect your interest rate. The most important factors are credit score, credit history, loan term, down payment, debt-to-income ratios, and the vehicle's age and condition. Your credit score matters the most. If your score is low, your interest rate will be high. Credit history includes your credit score, but also looks at details like how much credit you use and if you miss any payments. Car loans can be anywhere from 12 to 84 months long. The longer loans usually have lower monthly payments, but higher interest rates. Lenders set their rates based on the average market rate. Therefore, if the market rate goes up, your rate will likely be higher too. The loan-to-value ratio is how much of the car's value that you're borrowing. If you borrow less compared to your car's value, your interest rate will be lower. A larger down payment can also lower your interest rate. Zero down payment loans exist, but they usually come with higher rates. The debt-to-income ratio is the amount that you pay in debt compared to your income. Lenders use this to see if you can afford the loan. A lower debt-to-income ratio means a lower interest rate. Finally, loans for older cars in bad condition will also come with higher rates. A car's value depreciates at different rates depending on its year, make, and model. The biggest drop happens in the first year, with most cars losing about 20% of their original value. After that, the loss does slow down, but by the end of 5 years, cars usually lose about 60% of what they were first bought for. Understanding car depreciation can help you make smarter financial decisions. When you trade in or sell an older car, its value is typically lower due to depreciation. However, if you keep your car longer and take good care of it, you might still get a decent trade-in value, especially for popular models like certain trucks. Depreciation slows down after a car surpasses 100,000 miles, so well-maintained older vehicles can be more valuable when traded in. For car buyers, depreciation offers opportunities for savings. Used cars cost less than new ones because they lose value over time. You can purchase a car that's about a year old for roughly 80% of its original price. Buying a vehicle from the current or previous model year can help you avoid the steepest depreciation and still benefit from retaining factory warranties. Choosing a certified pre-owned car ensures you get a vehicle that has passed through thorough inspections. To minimize the impact of car depreciation and maintain a higher resale value, keep up with regular maintenance and document it to show potential buyers. Selling your car privately can help you get a better price than trading it in at a dealership. Avoid custom modifications as they can make your car less appealing to a broader audience. If you use your car for business purposes, check with a tax advisor about the possibility of deducting some of its depreciation on your taxes. Car insurance costs continue to rise. According to a report from Bankrate, average premiums for full coverage auto insurance hit $2,543 in 2024, which is a 26% increase from 2023. In 2024, several states have seen significant increases in their auto insurance rates compared to 2023. New Jersey has experienced a 45.69% increase. Missouri rates went up by 44.16%. Rhode Island saw a 42.29% increase. Colorado's rates have increased by 36.83%. Nevada has experienced a 27.73% increase. Car insurance rates are influenced by a variety of factors. Your credit history is one key aspect. In fact, most states' insurers consider your credit score when setting rates. Therefore, improving your credit score can help reduce your insurance costs. Your driving record also plays a significant role. Avoiding speeding tickets, DUIs, and other high-risk behaviors, as well as maintaining continuous coverage, can help you keep your rates lower. If you already have a poor driving record, looking into car insurance options specifically for high-risk drivers might be beneficial. The type of vehicle you drive can affect your insurance costs as well. Certain cars are just more expensive to insure, but vehicles that have built-in security or safety features may qualify for discounts. Additionally, your driving habits impact your premiums. The more you drive, the higher your rates are likely going to be. Finally, demographics such as gender and age are considered in most states when determining your insurance premiums. Some ways you might be able to save money on your car insurance is by improving your credit score, as many insurers offer lower rates for better credit. Shop around and compare quotes from different insurance companies to find the best deal. Consider raising your deductible, which can lower your monthly payments as well. But be sure you can afford the higher out-of-pocket cost if you have an accident. Ask about discounts for things like bundling your car insurance with other policies, having safety features on your car, or maintaining a good driving record. Based on AAA's data, the average monthly cost of owning and operating a car is $1,015 a month. The organization used 6 categories of costs to determine their average: fuel, maintenance, repair and tire costs, insurance, license registration, taxes, depreciation, and finance charges. That estimate assumes 15,000 miles driven per year. To save money on car expenses, consider these tips. For fuel, watch the lead foot and keep your tires properly inflated. Regular maintenance can prevent bigger repair costs later. While it might seem like a hassle, take some time to shop around for better insurance rates every year or so. And if possible, pay off your car loan as early as you can to save on those finance charges. Also, buying a used car can also help reduce depreciation costs. Think about your driving needs and have a budget before you buy a car. Calculate all the costs, not just the purchase price. Look at the sticker on the car with the estimated fuel costs to have an idea of what you should expect to pay in fuel per year. Plan for regular expenses like fuel and maintenance, as well as unexpected repairs. This way, you can better manage your car costs and avoid any financial surprises. Auto loan debt is the second largest category behind mortgages. Overall, Americans owe $1.616 trillion in auto loan debt, according to the Federal Reserve's Bank of New York, accounting for 9.2% of all American consumer debt. Americans are also taking many years to pay back their auto loans. The average auto loan term is 67.6 months for new cars and 67.4 months for used cars, and 36.1 months for leased vehicles, according to Experian. That means that over the life of an average auto loan at 67 months, at 9.56% interest for a new car, at $48,644, you'll end up paying $68,369.82, including interest, fees, and taxes, assuming you didn't put anything down. As for a used car, you'd end up paying $36,452.44, using that same statistic based on the average used car price of $25,251. Auto loan debt is no joke, and it can be dangerous because it can lead to financial stress and long-term money problems. When you take on a car loan, you commit to monthly payments for several years. If you lose your job or have other unexpected expenses, it can be hard to keep up with these payments. Missing payments can hurt your credit score, making it harder to get loans in the future. High interest rates can also make the total cost of the car much more than its original price. People often justify taking on auto loan debt because they need a car to get to work, school, or run errands. They might think they can handle the monthly payments and believe it's worth it to have a reliable car. Some people might also want a new or better car for comfort, for status, or just to feel more secure on the road. While these reasons make sense, it's also important to carefully consider the long-term impact of taking on such debt and to make sure that it fits within your budget. If you want to learn more about growing your wealth, then check out this video right here. But before you do that, don't forget to like and subscribe. Thank you all so much for watching. I really hope you liked this video and that you got something out of it. I'll see you in the next one.